Welcome, everyone. Thank you for joining us today. My name is Leah Weston from Avalara, and I'm also joined here by Jennifer Beasley from Nomad on the call. And our webinar today is brought to you by both Nomad and Avalara. Today we are discussing simplifying sales tax compliance, and I have just a few housekeeping items before we begin today's call. We are recording today's session, and everyone who registers will receive an email with a link to the recording in the next few days. The session will run 45 minutes, and then at the end, we're going to leave additional time for Q&A. If you do have a question throughout the webinar, please don't hesitate to submit your question through the Q&A box at the bottom of your screen. If for some reason we don't have time to address your question, we will reach out to you directly and follow up after the webinar. I'd like to introduce you to our speaker today, Diana DeBello. She is the product solution engineer at Avalara, and Diana has spent over 25 years working with various industries in supporting sales tax and use function. Diana, I'm going to pass it over to you.
Great. Thank you, Leah. Hello, everyone. I am so happy to be here today to talk to you about sales and use tax and ways you can simplify your compliance challenges. So in today's session, I'm going to cover the following topics: the changing tax landscape, the impact of economic nexus laws, why tax compliance matters, how Avalara and Nomad can help, some additional resources that you can use once you get the slides to go and find out more information about the fun topics we're going to discuss today. And finally, as Leah mentioned, we'll leave some time for Q&A. So the changing tax landscape. A lot of things have changed in the past couple of years in the sales and use tax world. And of course, COVID-19 changed everything. I'm sure everyone is probably tired of hearing about this by now, but it's affected businesses dramatically in many ways. So it's affected everything from supply chains and business operations to buying habits. I'm usually on the road a couple times a month. I have not gone to the airport in so long, I might need to use Waze to get me there the next time I go. The forced closure of non-essential bricks and mortar businesses, and then the acceleration of e-commerce and digital goods and services. So previously, people might go to bricks and mortar stores, but now it's much easier for them to purchase goods, or safer for them to purchase goods via e-commerce. And then, of course, a number of the states enacted tax relief measures that were enacted to soften the blow to businesses. Now, most of these tax relief measures have been retired, but it's always good to keep in touch and keep on top of that. We have a website that we'll share at the end where you can go and see what the measures were, and then if any are additionally enacted, then they will be there as well. So we keep on top of those trends and can keep you posted on what's going on. So the e-commerce trends during COVID-19 were dramatic. It was 129% year-over-year growth in the US and Canada for e-commerce orders as of April 21st. During the pandemic, the height of it, Amazon prioritized the sales of essential items, and then they stopped delivering inventory of some of the non-essentials. But according to some of our transactional data analysis, businesses with no e-commerce capabilities saw a 74% decrease in transactions. And the types of sales that were down were formal wear, dental services, car products, and sports equipment. And then, of course, sales were up in cleaning supplies, home office supplies, fitness equipment, hobby home improvement supplies, and kids' entertainment. And of course, I guess the toilet paper falls into the cleaning supplies. So not only have we had to deal with the pandemic, we've also had to deal with a number of tax law changes over the past couple of years. So traditionally, companies that are making sales need to meet a certain presence within a jurisdiction for that jurisdiction to require them to collect that sales tax. That's called nexus. So prior to 2018, the standard was a physical presence nexus. Well, now we have economic nexus. So in 2019, 21 states adopted economic nexus laws as of December 31st, 2018. And then by the end of 2019, 43 states have enforced economic nexus. So that's a huge jump. And then Missouri and Florida are two states that have yet to implement an economic nexus standard. They do have proposed legislation periodically, so we'll see what happens with those states. And then another thing that came out of all of this was the tax obligations for marketplaces. So think of Amazon, Etsy, eBay, all of those marketplaces, Walmart.com, where companies or businesses can sell their goods online. So what the states have decided is that marketplaces need to collect tax on behalf of their customers. So the sellers who are selling on the marketplace. So Amazon has pretty much been collecting the sales and use tax for a couple of years, but now I think they're pretty much collecting it in all the states and facilitating that for all of their customers. So as of January 1st of this year, 36 states have implemented marketplace facilitator laws. So that means if you're selling on a marketplace, you may have your marketplace provider collecting that tax on your behalf. And then international compliance. So many businesses are going international now. You know, we've always been the odd man out in the way that we handle our transaction taxes, if you will. We have our state and local taxes, and it's all sub-federal. So we have the states, the counties, the cities, etc. Whereas most of Europe and a lot of the other countries in the world just do a national tax. So we are a little bit unique in that respect. But a lot of businesses feel that they can expand their footprint by selling internationally. So cross-border e-commerce sales are forecasted to reach 1 trillion in this year, which means a lot of transactions. What does that mean for US companies selling into other countries? There's a number of requirements, laws, regulations that have to be followed, and it can be pretty complex in trying to implement that. So it's estimated that by 2022, that cross-border e-commerce sales could account for more than 15% of the world's online retail market. So it's important to keep that in mind. And if you are selling internationally, you're going to have to worry not only about the taxes, but you're going to have to worry about duties and tariffs as well. So knowing that, you need assistance in getting your goods international, you'll need to handle the tax side of it as well. So we talked about the economic nexus. So what was the impact of that? So on June 21st, 2018, the U.S. Supreme Court issued its decision in South Dakota versus Wayfair in favor of the state of South Dakota. This overruled that physical presence rule that I mentioned that was set by Quill Court versus North Dakota, another famous landmark U.S. Supreme Court case that was heard and decided in 1992. The ruling undid more than 50 years of precedence that was first established in 1967. So all of the U.S. Supreme Court cases that have come up and have been heard up until this point have made that bright line test be a physical presence. And what do I mean by physical presence? That means a person, a place, leased equipment, consultants, that type of thing. So once you have that physical presence in a jurisdiction, that jurisdiction can require you to collect the taxes for their state. But Wayfair changed that all. So now 43 of the 45 states with the sales tax have adopted an economic nexus provision. Now the thresholds for the economic nexus vary by state and it varies by the base. But let's look at how it changed. So back in January of 2019, that's what the map looked like. The blue are the states that would have an economic nexus law. Some of the states implemented this even before the decision of Wayfair, hoping that a case like Wayfair would come up. So they put the laws on the books ahead of time. So you can see here in 2019, a year after the court case, there were quite a few states. But look at December. Almost all the states that have a tax, except for Missouri and Florida, have imposed an economic nexus threshold. And then, of course, there's always the nomad states, which are the states that have no state sales tax. And that's New Hampshire, Oregon, Montana, Alaska, and Delaware. So I mentioned that the economic nexus thresholds vary by state. So if you're in Connecticut, you have a threshold of $250,000 in sales and 200 plus retail sales. Whereas in Georgia, it's only $100,000 in sales or 200 retail sales. And then, of course, we have other states like California and Texas that are $500,000 in sales. So there's a variety of ways that the states are implementing this. Now, Kansas is special because they decided that all remote sales leave the seller liable to collect their tax. So they don't have a threshold. They say if you make remote sales in their state, then you're required to collect the tax. So there's probably going to be a court case that's going to come up to fight that if it hasn't already. So that we'll wait and see what happens, but the states are all out there trying to get that money. Why do they want that money? Because they feel that they have lost so much revenue over the years to internet sales. And if you look at some of the increases in their revenue over the past couple of years prior to COVID, then you will see that they have increased their revenue intake. Now, an important thing to remember is that physical presence is still a nexus generating activity. So remember that there may be activities that you're doing, or you may have leased property in the state, or you may have a click-through nexus agreement that creates nexus for you in a state. You could have affiliates, so depending on how your companies are related or how your contracts are with your partners, it may create nexus for you. There's always the economic nexus and the marketplace facilitator laws. So when must businesses collect tax? It all comes down to the nexus, which we've been talking about. And until this connection is established, the taxing jurisdiction cannot impose its sales tax on a business. And then we have some of those business activities that I just mentioned. So all of these could potentially create nexus for you in a state. And I say potentially because, of course, the states vary in their interpretation of what a physical presence is, just like they do with the economic nexus. So I mentioned the marketplace sellers, the marketplace facilitator laws. So sellers that are using Amazon, Etsy, eBay, Walmart, etc., you need to know that these marketplace facilitator laws exist in at least 36 states. The law is intended to reduce the burden on sellers who are selling into those states by forcing the marketplace facilitators to collect that tax. So it's important to know that as you're going to sell goods online, if you are using these marketplaces, you need to understand how you're going to get that tax collected if they are facilitating that for you. And then how do you exclude those taxes from your return when you're filing your regular returns? Or do you have to report it? Some states require you to report the marketplace sales. Why does it matter? Well, not only does states' revenue, do states' revenues provide services for the residents of that state, most of the state's revenues easily come, a majority of it comes from sales and use taxes. So you can see here, there are selective sales taxes. Those might be specialty sales taxes like on rental cars or that type of thing. Then there's general sales and gross receipts taxes, which are 30.5%. So if you look at sales tax as a whole, 47% of the state's total revenues. So that's a significant amount of revenue for the states, and they don't want to lose any of that revenue. Interestingly enough, a lot of states have forecasted significant drops in revenue, and the states that rely more heavily on sales and use tax are really seeing the pain from the pandemic. I've seen states that are predicting a 20% decrease in their revenue. So that means services will be cut, and there will be a lot of issues with them trying to reconcile their budgets. I didn't say balance, I said reconcile. All right, so market dynamics are increasing tax compliance complexity. So it's not just the old days when you go into a store and you'd buy something and on the cash register would be the little chart that the seller could look at and add the sales tax to. No, it's changed a lot. Companies are managing growth. Most companies are trying to move into an omni-channel retail environment. They're trying to provide digital services, or they're opening new markets. Everyone is trying to find a new way to bring in revenue. Digitization of accounting. So live reporting is a reality in some countries where you have to send the invoice information real time to the jurisdiction. Artificial intelligence and machine learning. So there's a lot of ways that our systems can learn as they're going through processes. And then self-service or zero touch. Then, of course, we have cross-border commerce. So this is the ever-changing import tax rules and rates. Product classification complexity. So when you ship to other countries, you have to identify what it is that you are shipping. The B2C landed costs. So when you're selling to consumers, you have to know what that cost is for the taxes, the duties, and the VAT and the tariffs, and then customs duty and import tax. So there's all kinds of complexity that comes into play when you're dealing with cross-border commerce. There's changing regulations, so the e-invoicing requirements, like I mentioned, where you have to send that invoice information immediately, and live reporting requirements, where all of that is real-time reporting to the jurisdictions. And then complex beverage and alcohol regulations, and complex telecommunications regulations. So not only if you are selling these things, but if you're purchasing these things for your business, there's a lot of complexity and a lot of risk of error or overcollection, overpayment, underpayment. So it's important to understand that. And then, of course, we have our government actions. So what are they doing? They're creating the economic nexus laws. There's Making Tax Digital in the EU. There's Marketplace Fairness Act. And then there's transactional authorization. So there's a lot of government or regulatory actions being pursued in order to get information sooner, and revenue. So compliance is not optional. These laws are not if you feel like it. And the states are needier and greedier. So sales taxes are a large part of the state's revenue, like I showed you in that pie chart. Billions of uncollected sales tax revenue from e-commerce. So the states feel that there's still a lot of uncollected sales tax from e-commerce transactions, and the states are implementing new laws and initiatives to recoup some of that. So they have the economic nexus laws, marketplace fairness laws, and use tax reporting laws. We didn't touch on use tax yet. So the rapid growth triggers that are tax challenges. So companies are adding new areas to sell to. A lot of you are implementing new technology solutions to help you in this process of trying to expand your revenue growth, and then mergers, acquisitions, and fundraising. There may be changes in staffing. And then, of course, the ever famous sales tax audit. So when a sales tax auditor comes in to look at your information, you want to know that you have that correct, accurate, and easily available. So Jennifer here gave us a quote. She is the IT director at Walton Signage, and she says that any efforts spent on sales and use tax compliance and related activities are non-revenue generating. And I totally agree with that. My opinion is, though, that sales tax is a pass-through tax. So that means that when you charge your customers the correct sales tax, then it is just a pass-through. So you're not paying that tax, your customer is paying that tax. So the only cost to you is the cost of facilitating that collection of the tax. However, if you don't do it right, then the cost of that tax will most likely be your cost and penalties and interest on top of that. So for me, it's always important to get it right at the beginning so you don't end up paying at the end. So for manufacturers and distributors, there are some special scenarios that affect the business. So a lot of times we'll hear from distributors or manufacturers that most of my sales are exempt, so I don't have a sales tax problem. Well, the truth is that these are some of the biggest audits. So let's say I'm a state auditor, I have the option of auditing a retail business or a distribution business. If I audit the retail business and find that they have not updated a rate, say it was 6.9% and it should have been 7, I get to collect that difference. But if I audit the distribution business and find that they have invalid exemption certificates or haven't paid use tax, I get to take all of that money for the state, plus penalties and interest. So auditors are going to look to these types of businesses because they can get a lot of information. And exemption certificates are the same thing as cash money for an auditor. Missing an exemption certificate can cost you thousands of dollars in an audit. So that is a quote that came from a manufacturing company. Avalara Cert Capture is one of our solutions that's fully integrated with our tax calculation engine. And what it does is it really covers the life cycle management of collecting, storing, tracking, reporting, analyzing, utilizing those certificates. So what it does, it allows you to do customer outreach by providing letters and a communication portal to get those certificates from your customer. You can track those communications, you can build campaigns, you can report on upcoming expirations, you can analyze your exposure, and you can utilize the status to ensure that an exemption is only taken when it's a valid certificate. Exemption certificates is an area that most auditors do look at. And I have been in an audit situation where the auditor has said that the certificate is not allowable because the name doesn't match. Even if it's a DBA type situation, you would think that if it's one of the names, it will match. But if your certificate name, the name of the company on the certificate does not match the name on the invoice, then the auditor can disallow that certificate. If it's expired or it's not completed correctly, the auditor may also disallow it. So that's always an area that auditors will look to for places to find exposure. So then you hear, but what if I or my customers don't collect sales tax? Well, it can be ugly. So here's the case study for some companies that had exemption certificates. So this manufacturer in New York, 99% of the sales were to other OEMs or reseller dealers. No tax, exempt for resale. The Wayfair ruling increased their burden to prove exempt sales. The previous exemption certificate count was less than 75 on file because it was just limited to their state. But with the economic nexus laws, that required them to have nexus and report in the other states. They now need to manage almost 1,200 exemption certificates. So it really changes the burden for that company. The other case study is a national wholesaler who sells to resellers, and they sell to the end users, and drop shipment is part of their model. Wayfair grew Nexus for them outside of New York. Their previous exemption certificate count was 500, and their new count needed is 5,000 plus. So managing those exemptions can be very burdensome if you previously only had a local nexus, and now after post Wayfair, you have nexus in numerous states. So let's look at drop shipping challenge, because a lot of manufacturers and distributors deal with this type of scenario. So this is a seller that's ordered a drop shipment for a customer in Texas where the seller does not have nexus. However, the drop shipper does. They may have a warehouse or trucks or some other nexus in that state. In this case, the seller invoices the customer but does not charge them tax. The drop shipper delivers the product and incurs a tax liability because they have nexus in the delivery state. Since the drop shipper has a tax liability, how does this transaction get settled? So this is a challenge for a lot of companies and has been for a long time. When I first started in this industry a long, long time ago, drop shipments were one of the big challenges for the manufacturing company that I worked for. We had a limited nexus, or then we ended up having nexus in most of the states that we sold to, but when we would drop ship sales to our customers, we had a challenge. So the reseller wouldn't have nexus in the destination state. So in this case here, the drop shipper must invoice the seller for the tax that they will remit to the government. The seller then has the option of paying it or eating the tax, or the seller may register in the customer's state and assume the burden of collecting tax from their customer and filing in that state. The seller may also need to provide the drop shipper with a resale certificate for the customer's state so that the drop shipper can avoid charging them tax. Now, another alternative, which may not work in all states, is that the seller who doesn't have nexus may be able to provide the drop shipper with a home state resale certificate that the drop shipper may use in the customer's state. This would eliminate the need for the seller to pay the tax, and then to the drop shipper to collect the tax from the seller. So keep in mind, not all states will accept that certificate. And just because you have a multi-state certificate, if you are not registered with the state, it does not necessarily mean that you can then say you are exempt in that state. So you need to understand the nexus rules and understand how they can apply to your specific scenarios. So how can Avalara and Nomad help? So here is a picture of the whole solution. You can see here along this row is the Avalara layer. This includes your cert capture for exemption certificate management, AvaTax for tax calculation, and then returns for managed filing. What this accomplishes is it covers that whole end-to-end sales tax compliance need. You can have all of your certificate management handled, to collect those certificates, to store them, and to have them when you have an audit. Then Nomad provides all of your customer info to cert capture so that we can identify those exempt customers we need to collect certificates from. Then all of your transaction information will be fed to AvaTax to get that tax calculation, and we return that back to your systems. And then, of course, we'll take all of that tax calculation information to create returns and file them on your behalf. So it makes it a little easier for companies who don't have a 40-person tax department to handle all the complexities for sales and use tax compliance. It gives you an easy system to configure and set up, and then you have the support to handle those transactions. So the states can lend a hand in this process, believe it or not. There is the streamlined sales tax, and this project was started many, many years ago. It was an effort by state and local governments to simplify sales tax compliance. A qualified business that's eligible for free sales tax calculation and filing in the 24 SST member states when using a CSP. So we are a CSP. We provide the certified service provider solution on behalf of the 24 SST states. Businesses must qualify as a volunteer seller. So they must have no place of business for more than 30 days in the state, less than $50,000 of property and payroll in the state, and less than 25% of total property or payroll in the state. So this is a good opportunity for a lot of companies who may have an economic nexus, but they don't have the physical presence in those states. In those situations, the states will pay us to do the calculation and the filing on your behalf. So it makes it easy to give you that free solution and may cut that burden financially. The benefits of automating sales tax management, you're going to have the benefits of being accurate. So you're not managing everything with Excel spreadsheets or on the back of a napkin. You have efficiency, so everything is real time. Risk management, you have reporting and you have documentation of everything that you do so that your risk will be minimized when it comes to audit. Customer satisfaction, your customers, if you're using shopping carts, can get their tax calculation before they check out or at checkout so that they know how much the whole sale is going to be. And then it allows you to free up resources to focus on higher value projects. One of the challenges, especially for manufacturers and distributors, is consumer use tax. Now, you can use our AvaTax solution to calculate consumer's use tax on your accounts payable transactions. However, a lot of times there are other things that come into play with the consumer use tax transaction. So a consumer use tax is the tax that is imposed on the purchaser when the buyer either doesn't charge you a sales tax, or charges you the incorrect sales tax. Other reasons why you may need to pay a consumer's use tax if you use a direct pay permit, or if you have items that you are removing from inventory for your own use in the business. And also another area of consumer use tax concern is samples. If you're providing your customers with samples or using demonstration items for your business. And then finally, there may be a need to allocate some of your purchases to multiple locations. Software or IT spend is a big area where consumer use tax can come into play. An example of this is SaaS software is taxed at 80% of the base in Texas. So if you have software that you are using in multiple locations, then there may be an opportunity for some savings there. So it's important to understand where your locations are, what types of challenges you have. Another area is goods or equipment movement. So if you're moving things from one state to another, you may be creating a use tax liability. So what we've done is we have created Avalara Consumer Use Tax, and this solution is fully integrated with AvaTax, but allows you to provide reporting from any system into ACU and calculate an accrual for your use tax so that your returns include your use tax calculation. You have reports that show what those use tax transactions are, and it's reported, and you don't have to worry about it when these transactions occur after the original purchase. So that brings us to the additional resources that we have. I mentioned them previously in the presentation. So there's a lot of tools that we have available for you to use and review. You have the SST. So if you think you might qualify for SST voluntary compliance, then you can go to this website and see if you qualify and what the next steps are. And then keeping up on the latest tax relief efforts. So you can see here what some of those items are and what their expiration dates were, and if you can still take advantage of them even if they were in the past. And then finally, why Avalara? We have over 700 pre-built integrations to widely used ERPs, accounting, e-commerce, and business applications. Or you can connect your way using our advanced API. So we have an API that's available to, if you have a custom system or a homegrown system that you need to connect to a tax engine, then you can certainly use the API. We have support for global commerce, and then we have done an awful lot of tax calculations in the past couple of years. And then you have peace of mind. So there's risk-free, proven reliability, and we do have some product guarantees available to you. You can learn more at the website. And now we have time for some Q&A. So why don't we get started with that? Leah, if you want to let me know what some of the questions are.
Yes, thank you, Diana, and thank you for that wonderful presentation. We're going to open up the Q&A now. So if you'd like to type in any questions, we'll be sure to get to those. And Diana, while we're waiting for those questions, I had a question of my own.
Sure.
When you hit an economic threshold, are you automatically registered in the state?
No, you're not automatically registered. So when you hit that economic threshold, then you need to register with that state. We have services we can assist you with that can help you get registered in the state. If you currently use Avatax, you can just go to that heat map that we have for the economic thresholds, and you can say, I want to register in this state. But you do need to take that initiative and register in that state.
Okay, great. And one other question would be, how bad would it to be, how bad is it to have an approach of a wait to find me if we may have Nexus but not registered?
So I've heard more than one company over the past couple of years say that they want to do that. I have a good friend of mine that is in public accounting, and she was telling me about one of her clients that was, she had advised that he had hit the economic threshold in New York. And he said, no, I'm not going to do it. They may change the rules. I'm just going to not collect tax in New York. And she requested a couple times, you know, said, I think you should really file in New York. And he didn't. And she told me that he got a lovely letter from the state of New York with a jeopardy assessment of $2 million. So waiting until they find you can put you out of business. It's important to know where your exposure is and then try and comply as best you can with the laws of the state, because not collecting can really put you and your business in jeopardy.
Hmm. Great, thank you. Okay, we'll wait a few more minutes if there are any other questions.
I have a question here that talks about how difficult is automation to implement and set up. We are a small business and my firm does not have a lot of staff time to dedicate to tech support. So setting up the automation with these tax solutions is fairly easy. With the 700 plus integrations and our integration with Nomad, we can provide you an easy way to get up and start calculating taxes. And then the rest of it we can handle. So once you get configured and you get Avatax running with your systems, we can do the returns for you. And then you're going to be collecting all of those certificates with CertCapture. So it really decreases the amount of time you're going to have to spend on sales and use taxes once you get everything configured and implemented. It does take a little bit amount of time, but it's not difficult. And if you have the right partner to assist you, then it's going to work really well.
Great. And one last question for you. What would you recommend if my company exceeds most of the state's economic nexus thresholds, but is not registered anywhere yet? I'm just
That
registered
is,
in the home state.
yeah, that's a great question. This is something that a lot of companies are concerned about now because they never collected the tax before, and all of a sudden it doesn't take that much to hit $100,000 of sales, or if it's just an or 200 transaction state, then it can be very easy to hit that. So if you fear you have economic nexus in a large number of states, if it's economic nexus only, I would suggest reaching out to us to do a nexus study to make sure you have no physical nexus. Then you have the option to voluntarily collect in one of the SST states. Now, economic nexus makes it a not voluntary anymore, but the SST is still looking at only physical presence to disallow you from the program. That if it's just economic presence, you can still get into that program. There's 23 states. So that will make it easier and more cost efficient to start collecting taxes in those states. If you have a lot of exposure in those states, it would be suggested that you do what's called a voluntary disclosure agreement. And what that is you have professional consultants. We have a professional service team that can do VDAs, will evaluate your exposure, and then negotiate on your behalf um, anonymously with the jurisdiction, saying that you want to come clean with them, and then try to minimize any penalties or interest that you might have to pay or get you on a payment plan. So those are the best steps to get you to minimize your exposure once you've identified that you have some of those nexus generating activities.
Great. Thank you, Diana.
You're welcome.
Well, that's all the questions we have at the moment. So if you do come up with any other questions following the webinar, please feel free to reach out, and we're happy to answer those directly. And actually, here we go. This is Jesse Luter's information, who's available to help with any additional questions that come up. And we'll also be sending, just a reminder that we're sending out that follow-up email, which will include the recording and contact information as well in the next few days. So thank you again, Diana, and thank you, Jennifer, for helping to coordinate this webinar with Nomad and Avalara. And I hope you all have a wonderful day.
Thank you, everyone.